markets. Let's get perspective now from market veteran Jim Bianco, founder and president at Chicago-based Bianco Research, which provides data-driven analysis and market commentary. Jim, good to have you with us. You know, we know that tariffs remain front and center, but there seems to be no reaction whatsoever in the markets. I mean, it's not even showing up in the different asset classes.
At least not yet. And I think the reason it hasn't shown up is because it's still hard-pressed to find it in the inflation data, that the end user, the consumer in the United States, is actually paying higher prices for it. Now, that might be coming because there's some evidence that in April and in May and into June, a lot of exporters, China, for instance, Japanese automakers, to give an example, cut their prices initially right after Liberation Day. And that cushioned the final price that U.S. consumers paid. But starting in July and into August and through September, they're expected to raise those prices again back to pre-Liberation Day levels, in which case, by the end of the third quarter and into the fourth quarter, we should start seeing some inflation numbers. And if that's what we do see, then we'll start talking about a tariff impact.
But what kind of numbers, what kind of impact? Some are perhaps making comparisons to Nixon's tariff regime in 1971. We're talking about 10% at that time, but that left no impact whatsoever on earnings.
Yeah, at least it will have an impact on the inflation numbers, and it'll have an impact on the earnings of who's ever an importer. And the like. You know, Apple did detail some of the inflation tariff costs on their iPhone production, and it is having some kind of an effect on them. And I suspect what you could see is that by the end of the third into the fourth quarter, a lot of the inflation statistics will go over 3%. Now, why is that important? Because after the weak payroll report that we saw last week in the United States, the Fed will be put in an impossible situation. Cut rates because of the weak payroll report. You absolutely cannot cut rates if we have 3% inflation at the same time. And they'll be faced with a bad choice. Whichever choice they pick will be wrong. And then you'll have President Trump hanging over them and threatening to fire Jay Powell if he doesn't do what he wants him to have done.
What choice do you think the Fed will make? What do you see the Fed doing in the coming months?
I think the Fed is leaning towards cutting rates right now. I think that the pressure is building on them because of what we saw in the labor market. I personally think it will be a mistake if they were to cut rates, because I don't think that that's going to solve the ills of the labor market. And I think it will just stoke more inflation in the United States. But I think that we're going to see that. And don't forget that President Trump has said in the coming days he's going to announce a replacement for Fed Governor Kugler, who announced on Friday she's going to resign effective as of this coming Friday. And then if that person is confirmed by the Senate before the September 17th meeting, that adds one more vote towards cutting rates with the Fed. And that might be enough to push them over the edge and see rate cuts as soon as September.
And you have suggested that that might lead to a shadow Fed. How will that be seen by the markets? How do you see the markets responding to that?
Yeah, so the shadow Fed is a term coined by Scott Bessent, the Treasury Secretary, that whoever President Trump announces as the Fed governor to replace Kugler, so maybe later this week or into next week, will also be eventually Jay Powell's successor when his term is over in May, unless Trump moves to fire him earlier. And that person will be the Fed chairman in waiting. And the idea is the market will turn their attention to them and what they think was going to happen, because they're going to be the Fed chairman for the next couple of years, marginalizing Jay Powell, making him a lame duck that he's got it'll be like listening to the president of the United States after the election that he lost. Everybody pays attention to the president-elect, will be effectively paying attention to the Federal Reserve chairman-elect for the same reason.
Jim, in the last few minutes, I can detect that there are a lot of issues to be concerned about. It's not being reflected in the market yet, you say. And also some suggesting that, you know, the bull story long-term remains intact. Are they wrong? Because they're suggesting perhaps you should be buying the dip right now.
Yeah, well, the dip buyers, they've got one thing going for them. It's always worked, and it's worked very, very well, and it worked again today. What I do think is happening, though, in the market, especially in the U.S. market, is there's been a market shift towards retail trading. Something close, probably the most retail-oriented market in the world might be India right now. But the U.S. is starting to see that happen, too. So if you really want to know who's the big power player in the U.S. market, it's not a hedge fund or a big institutional investor with a lot of assets under management. It's millions of retail traders, probably on some kind of social media platform like Reddit, getting talking and coming to conclusions together. And that's why dip buying, and that's why you've seen the meme stocks come, and that the powerful move we've seen in the Mag 7 and other related AI stocks. So there has been a shift. This is not the same market that we saw, say, pre-COVID.
Are you then suggesting, Jim, that perhaps it's the retail investors who will bear the brunt of a possible correction?
Well, whoever is the dominant player will bear the brunt of the correction. But I will say this as far as the retail investors go. They are raking in the profits. They are the ones that bought the market in a big way in April and May when the professional investor was selling. They are the ones that have been buying the market for the last 2 months while the professional investor has been talking about overvaluation. Now, the professional investor is correct. And maybe in the long run, that the professional investor might be proven correct and borne out. But throughout 2025, it has been the retail investor that has been the profit-driven investor, the one who's been making the most money. And that's why we've seen such an explosion in their activity in, say, the last 18 months or so.
If or when that correction comes, how deep will it be? We have Morgan Stanley saying 10%, Evercore saying 15%. Might it be deeper than that?
If it was to be deeper than that, you would have to have another catalyst with it. See, the way I look at it, like a lot of professional market commentators, a market can always correct 10%. The question is, can it go more than that? Well, it would need something like higher interest rates, a market slowdown in the economy where there's unmistakable thought of recession, maybe inflation driving those higher interest rates, or something like that. If I had to put, some probabilities on it, I'd say the highest of those is that we could see long-term interest rates move up. And that could really bother the stock market if we were to see a correction that could go more than 10%. Now, maybe the Fed is going to cut rates, but we saw this last year. The Fed cut rates last year. The market didn't like it, and we saw long-term interest rates go up right after the Fed cut. If we could see something similar to that again, and if long-term interest rates go up, I could see a 10% correction becoming something more.
Jim, I'm curious, some suggesting that perhaps it's the bond market that's standing between us and a financial collapse. Is that too melodramatic? Or is there any truth whatsoever?
Well, it depends on how you define it, but in some respects, it is the bond market that will, be the ultimate arbitrator of what's happening. In the U.S., we have giant budget deficits of around 7% to GDP. We've got a government budget overall that is about 24% of GDP. If you look at the 200-year history of the U.S., the only time it's ever been this large has been crises like COVID and World War II. Yet this is now kind of the average run rate in a peacetime, non-crisis environment. So this is unprecedented what we're seeing. And a lot of people like me think that this is unsustainable. Well, we're not going to find any kind of politicians to elect to Washington that are going to fix this budget problem. So the only place it's going to get fixed is the bond market is going to reject all of this borrowing. And it's going to say, if you want to borrow to keep it 24, 25% of GDP at the budget and 7% deficits to GDP, interest rates are going to skyrocket and you're going to have to pay a heavy price in order to do it. And then that will force some kind of a reform on Washington in order to bring the budget deficit and spending under control. So the bond market is the only place that can do that. Now that I've said that, when does that happen? Does it happen later this year? Does it happen in 10 years or somewhere in between? That's the open question. But what I am trying to argue here is I know how we're going to fix this. It's going to be the bond market through punishingly high interest rates. But we don't have that just yet. But that's really the only mechanism we have to rein in the profligate spending that we've seen in Washington.
like you said, there are structural issues. We've heard time and time again from Trump that he wants lower rates. It is not just about removing Powell from his position. Yeah?
Yeah, well, I think it is about, it is about lower rates. And he wants to remove Powell because he sees him as an impediment to lower rates. But I do think there's a fundamental flaw in the argument that he's making. Well, there's two flaws. The one is he argues that we are the best country in the world. Everybody wants to be in the United States. He calls it the hottest country in the world. And let's assume all of that is true, and it could very well be true. What he's trying to argue is the U.S. should have low interest rates because it's a good credit. But that's not how you price sovereign bond yields. That's how you price the mortgage on Trump Tower in Manhattan, is that if it's full and everybody desires to be in it, its mortgage rate should be lower than everybody else's. Sovereign yields are priced on inflation expectations, budget deficits, growth of the economy. And given all that, we should be around 5% yields. And that's the one argument that I think he's been giving. The other argument is a fiscal dominance argument. And what that means is he's saying cut interest rates, lower interest expenses in the U.S. Well, the problem with that is cut interest rates, lower interest expenses. Then what do you do when you have inflation? You never raise interest rates because that would raise interest expenses. Every time you get a fiscal dominance situation that you're setting interest rates based on the amount of borrowing you've done, it always ends badly. And that's another warning sign or worry that he's making that kind of argument again.
The focus is on 10 years. Of course, that impacts mortgages, corporate bonds, so on and so forth. And some say perhaps 4.5% is the new normal. If anything, it is higher than 4.5%, but not below.
Yeah, I think so. I think that one of the things is people have been anchored to that period between 2010 and 2019. Zero interest rates, negative in Europe, negative interest rates in Japan. The only time in financial history we've ever seen negative interest rates was 2010 to 2019, and 2% or so on long-term yields. That was an aberration. And so many people I hear, especially in the U.S. here, talk to me about yield curve control, money printing, return to zero interest rates. I think that era is over. And what we have to understand is 4%, 4.5% yields on 10 years is normal. This is where they should be. This should not be an impediment to business or to government borrowing or anything like that. But the problem is too many people in the U.S., starting with the president, think that this is an abnormal thing that is holding back the economy. It's not. These rates are not holding back the economy. They're where they should be. And I think this is a difficult thing for people to come around because they're still anchored to that thinking that we had pre-COVID when we saw zero interest rates.
So how do you position, Jim? What do you buy? I mean, we spoke to an investor just yesterday, Mark Mobius. He's still hanging on to 50% cash from 95% before.
I've been making the argument, bigger picture, that over the next several years, the U.S. markets will be what I've referred to as the 4, 5, 6 markets. That cash will return you about 4%, which is what it's done over the last year. Bonds will return you about 5%, which is what it's done roughly over the last year or so. And stocks will return you around 6%, not 20 to 25 like it's done over the last couple of years, mainly because of that professional investor argument about valuations. 4, 5, 6 is not bad. Especially if we're at what I'm also arguing is a 3% inflation world, which is a little bit elevated. Those are not bad investments. The problem is with the U.S. is people act like you've shot their mother when you tell them that 4, 5, 6, because they think all markets should be going up 20 or 30% a year, and they need to, rein in those type of expectations. So given that, I think a balanced portfolio, some cash, some bonds, some stocks, will do very well. Because remember that cash has no volatility. It has the same price every day.
Right.
And if a money market fund or a treasury bill can return you 4%, you'll get more than half the stock market's gains with no volatility. Bonds will give you most of the stock market's gains with a lot less volatility.
Right.
And then stocks will give you a little bit more. So 4, 5, 6 is where I think you'd want to start to think about the markets over the next several years.
Given the noise, 6 ain't too shabby. Jim, thank you. Jim Bianco, founder and president at Bianco Research. Still to come on